Right now, as we look at the live tape on this Monday morning, Super Microcomputer Inc. is trading at exactly $32.15. It is currently down 4 cents, which translates to a decline of 0.12% for the day. The time is 9:51 a.m. Eastern Standard Time. You might see that number and think nothing is happening. You might think a movement of less than 0.5% is just noise. That is the expectation. The market wants you to believe this is a dormancy phase. The market wants you to believe that the explosive volatility we have seen in the past is gone and that the stock has found a boring equilibrium. But the reality is vastly different. When you see a stock like Supermicro, which is historically known for violent swings and massive beta, sitting this flat during the opening hour of trade, it is not sleeping. It is coiling. This lack of movement at the $32 level is actually a high-tension standoff between institutional accumulation and retail capitulation. Most people engaging in online investment or checking their Schwab Intelligent portfolios are looking for the big green candles or the scary red drops. They miss the story that the flat line tells you. At $32.15, we are seeing a very specific battle over valuation compression. The expectation is that Supermicro is just a hardware box mover that got lucky with the AI wave. The reality, however, is that the company has become the primary bottleneck detector for the entire data center industry. When you look at the volume profiles this morning, even with this slight drop of 0.12%, the turnover is significant. This tells us that shares are changing hands from weak holders who are bored or scared by the lack of immediate upside to stronger hands who understand the multi-year cycle of data center buildouts. It is crucial to understand the context of this price relative to the broader sector. If you look at NVIDIA stock, you see the engine of the AI train, but Supermicro is the chassis. You cannot have one without the other. The market is currently pricing Supermicro as if the demand for AI compute is going to plateau, but every single earnings call from the hyperscalers suggests the opposite. We are seeing a disconnect between the stock price of $32.15 and the actual order book visibility the company likely possesses. This brings us to the psychology of the self-investing crowd. When you use a Fidelity mobile app or look at your Robinhood investments, it is easy to get caught up in the narrative that a stock down 90% from its highs is a broken company. But in the world of hardware, cyclical downturns are where the fortunes are actually made. The expectation is that the accounting issues and the margin compression are permanent flaws. The reality is that they are temporary growing pains of a company that scaled too fast for its own internal controls. Let us talk about the technicals at this specific intraday moment. The stock is hovering just above the $32 support. If it breaks below 32, we could see a flush down to the high 20s, which would likely trigger a wave of stop losses from those using Interactive Brokers' stock trading algorithms. However, the bid support at $32.10 is incredibly thick. This suggests that there is a large buyer, likely a fund or an institution, that has parked an algorithm right there to soak up any liquidity that spills over. This is not the behavior of a dying stock. This is the behavior of an asset being accumulated. You have to ask yourself why you are in this trade. Are you here for a quick flip on a Robinhood stock trading account, or are you here because you understand the thermodynamics of liquid cooling? The mention of liquid cooling is not just filler. It is the central thesis for the bull case that the market is ignoring at $32. As chips get hotter, specifically the new Blackwell architecture from NVIDIA, traditional air cooling doesn't work. You need liquid cooling. Supermicro is the leader in this specific niche of mass-scale manufacturing for liquid-cooled racks. The expectation is that Dell or HP will just come in and eat their lunch. The reality is that Supermicro's building block architecture allows them to customize and ship racks faster than the legacy giants. That speed is what the AI startups and the cloud providers are paying for. They are not paying for the brand name. They are paying for the time to market. When you are racing to train a model before your competitor, getting your server racks 3 weeks earlier is worth paying a premium. This is why the margin concerns, while valid, might be overstated in the long run. We need to address the elephant in the room, which is the trust factor. The delay in filings and the auditor issues have cast a long shadow over this stock. That is why it is trading at $32.15 and not $132. The market hates uncertainty more than it hates bad news. If the news was confirmed bad, the stock would be at 10. If the news was confirmed good, it would be at 60. We are in the purgatory of uncertainty. This is where the sophisticated money works. If you are managing a Fidelity brokerage account or looking into Fidelity wealth management options, you know that risk management is about probability. The probability of a total collapse is being priced in as if it's a coin flip. The reality is that the tangible assets, the factories and the intellectual property of Supermicro have a floor value that is likely higher than where the bears think it is. Comparing this to other sectors helps frame the valuation. Look at Tesla stock. Tesla went through years of production hell where the market doubted they could scale. Supermicro is in its own version of production hell, or rather internal control hell. They grew revenue so fast that their back office broke. That is a fixable problem. It is not a product problem. It is an administrative problem. Investors using SoFi active investing platforms often struggle to differentiate between a broken business model and a broken spreadsheet. Supermicro has a broken spreadsheet, but the business of selling servers is booming. This distinction is the gap between expectation and reality where the alpha is generated. We also need to consider the role of retail investors versus the algos. On platforms like Interactive Brokers, the Interactive Brokers trading tools allow for sophisticated hedging. We are seeing high put volume, which suggests many people are betting on a further fall. But when everyone is on one side of the boat usually tips the other way. A short squeeze is a very real possibility here if the company drops any positive news regarding its filing status. The short interest is crowded. They are comfortable at $32.15. They feel safe. That safety is an illusion. If the stock ticks up to 33, the panic covering could drive a rapid ascent that leaves those waiting for a lower entry price behind. Now, I want to hear from you guys. The sentiment on this stock is incredibly polarized. Comment below how many shares of Supermicro you currently hold and what your average cost basis is. Are you underwater and holding, or did you get in recently at these lower levels? I want to see where the pain points are in the community, because that helps us understand the psychological resistance levels of the stock. Let's move back to the intraday action. The volume is starting to dry up as we move past the initial morning rush. This lowering of volume while the price holds steady at $32.15 is a constructive sign. It means sellers are exhausted. If there were massive sellers left, they would be hitting the bid right now. They are not. The selling pressure is absorbing. This is a concept you might learn if you use SoFi Investing educational resources or Fidelity ETF's research tools. Volume drying up at support is often a precursor to a reversal. We are not calling the bottom, but we are identifying the friction that stops a falling object. We must also discuss the broader economic environment. We are in a period where interest rates are high, which usually hurts capital-intensive businesses. Supermicro needs cash to buy chips from NVIDIA to build the servers. The cost of that capital is high. This squeezes their margins. The expectation is that this cash crunch will suffocate them. The reality is that the demand for their product is so inelastic right now that they can pass some of these costs on, or they can raise capital because the equity story, despite the drop, is still compelling to long-term backers. You cannot build the future of artificial intelligence without the physical infrastructure. It is not just code floating in the ether. It is metal, silicon, and cooling fluid. Supermicro bends the metal. Think about the landscape of online investing today. It has become very binary. People either want the safety of a savings account or the lottery ticket of a meme stock. Supermicro sits in the weird middle ground. It's a real company with billions in revenue, but it trades with the volatility of a crypto token on Robinhood Crypto. This scares away the Fidelity mutual funds crowd because it's too volatile, and it scares away the pure gamblers because it's a hardware company with complex accounting. This orphan status is why the stock is mispriced. It does not fit neatly into a box. Is it a value stock? At this PE ratio, yes. Is it a growth stock? Based on revenue growth, absolutely. Is it a distress stock? Based on the audit news, yes. It's all three at once. The relationship with other tech giants is pivotal. We mentioned NVIDIA, but what about the competition? Dell is the safe pairs of hands. HPE is the legacy player. Supermicro is the race car. It's faster, but it might crash. Corporate CIOs are conservative. They like Dell. But the people building the massive clusters, the Musks and the Zuckerbergs of the world, they care about performance and density. Supermicro wins on density. Their green computing initiative is not just ESG market